Section 8. Unit 4, FHA Loans and the Consumer. Introduction and Objectives. Lesson 1, which FHA loan type should we use? Lesson 2, can we qualify for that FHA insured loan? Underwriting guidelines for FHA loans. Lenders that offer FHA insured loans must meet underwriting standards, which can be pretty complex. It's not necessary for you to learn all of the underwriting requirements, but a general understanding of the underwriting standards is useful for any real estate professional. Down payment requirements. Since January 1, 2009, FHA borrowers must place 3.5% as a down payment. This amount is calculated on the lesser of the sales price or appraised value. This may be in the form of their own funds, a family gift, or a grant from a local, state, or nonprofit down payment assistance program. The FHA does scrutinize the source of down payment funds, and doesn't allow the seller to contribute to the buyer's down payment. For some programs that allow for a higher loan-to-value ratio, LTVR, a portion of the 3.5% may be used toward approved closing costs. Loan limits. The FHA limits the loan amount it will insure based on the type of structure, e.g., single-family versus multifamily, and median home prices in the area. Mortgage limits are reviewed annually and can change every year. The FHA won't insure loans that exceed these limits, and therefore lenders won't lend on them, not for an FHA loan, anyway. Loans that exceed the FHA limit are considered jumbo, non-conforming loans, and they're not eligible for sale to Fannie Mae or Freddie Mac. Buy downs. Borrowers or sellers may buy down the interest rate for a period of time, which will reduce the monthly payments for that period. This lower rate may help some borrowers qualify for the loan. Seller-paid closing costs. One reason some sellers balk at an FHA buyer is that the FHA strictly limits the closing costs that may be paid by their borrowers so that the loan remains affordable. This may increase the costs that the seller will be required to cover in order to make the sale. The FHA allows the seller to contribute up to 6% of the sales price, or of the appraised value, if that's less, toward the buyer's closing costs, prepaid expenses, discount points, and other financing costs. Costs that can be included in this 6% limit are permanent and temporary interest rate buydowns, payments of mortgage interest for fixed-rate mortgages, mortgage payment protection insurance, which covers mortgage payments for a set period if the borrower is out of work due to accident, sickness, or unemployment, payment of the upfront mortgage insurance premium, UFMIP. Second mortgages. If a homeowner with an FHA loan wants to obtain a second mortgage on the property, the total of the first and second mortgage must be within the maximum LTV ratio. The borrower must qualify to make both payments. Toxic loan features, such as balloon payments maturing within 5 years, highly variable mortgage payments, and prepayment penalties, are not allowed. Assumptions. FHA loans don't use a due-on-sale clause, so it's possible for borrowers to assume an existing FHA loan. If the loan were originated before December 1986, it can be assumed without the new borrower having to qualify. For loans originated after December 1986, the borrower must pass a creditworthiness review before being allowed to assume the loan. Investors may not assume FHA loans. The property must be owner-occupied for the life of the loan. Qualifying income for FHA loans. George and Betsy want to buy a house, though they wish they'd saved more money for a down payment. After weighing the pros and cons of a conventional mortgage with an FHA mortgage, they've decided to apply for an FHA loan through an FHA-approved lender. Their mortgage broker explained that an FHA loan may allow a lower down payment than what's required for a conventional loan with slightly lower interest rates and more flexible credit qualifications. George and Betsy like the idea, so Mike explains the qualifying requirements for FHA loans, telling them that FHA qualifies borrowers using two types of income ratios, and that they must qualify under both ratios to be eligible. The first ratio is a housing ratio of 31%. George and Betsy's total housing expenses can't be more than 31% of their total gross monthly income. The expenses that are included when calculating this ratio are mortgage, principal, interest, property taxes, home insurance premiums, mortgage insurance premiums, homeowner or condo association fees, if applicable, George and Betsy's total monthly housing expense, if they get the loan they're applying for, equals 30% of their gross monthly income, so they qualify on that count. The second qualifying ratio is total debt obligations, also called the debt-to-income ratio. Their housing expenses, the ones that went into calculating the first ratio, plus any recurring debt, student loans, credit card payments, car payments, must not exceed 43% of their gross monthly income. They don't have much debt, luckily, and their second qualifying ratio works out to be 38%, well within the guidelines. If they'd exceeded those guidelines, sometimes compensating factors such as excellent job history, a larger down payment, additional income potential, etc., would still allow them to qualify. George and Betsy also must have a credit score of at least 580 to qualify for a 3.5% down payment. Borrowers with scores as low as 500 may still qualify, but they'll have to put at least 10% down. Lenders prefer a score of at least 620. In this case, George and Betsy have a perfectly acceptable credit score of 710. Congratulations, George and Betsy. You qualify. Using the FHA 203K loan. Kevin, rehab master, never goes anywhere without his tool belt. When he found a great property that needed a lot of work, he was itching to bring it up to snuff. Fortunately, FHA offers Section 203K insurance to lenders, which enables home buyers to finance both the purchase and the rehabilitation cost of a property through a single mortgage. Existing homeowners who refinance can also use the program. Of course, it was a fair bit of work just to get the loan. Kevin, who is a general contractor, not just a DIY guy, had to provide his lender with a detailed proposal of the work he needed to do, along with cost estimates for each item. An appraiser determined the current value of the home, as well as estimated market value once the rehab was complete, so that a loan amount could be established. Luckily, the combined cost of home value and rehab still fell within the FHA mortgage limit for the area. When Kevin closed on his loan, the amount above what is used to pay off the seller is the amount dedicated for the repairs. The contractor, in this case, Kevin, receives 50% of these funds up front. The rest are placed in an escrow account. Kevin will receive the remainder of the rehab funds when the rehabilitation is completed. He's got 6 months to get her done, according to program requirements, and approved by the 203K inspector. HUD requires that the work be completed according to FHA's basic energy efficiency and structural standards. FHA Special Loan Programs. Energy Efficient Mortgage allows the borrower to incorporate the cost of adding energy-efficient features to new or existing houses in combination with a 203B or 203K loan, or for 203H in connection with a disaster. Home Equity Conversion Mortgage. Insurance of a reverse mortgage for homeowners age 62 and older who want to borrow against their home equity as a lump sum or on a monthly basis, for life or a specified term. Good Neighbor Next Door. This program provides law enforcement officers, K-12 teachers, firefighters, and EMTs a deal on purchasing foreclosed FHA-insured properties in revitalization areas. Eligible buyers receive a 50% discount off list price with a down payment of only $100, provided the buyer lives in the property for 3 years. Homeownership Voucher Assistance allows participants to use Housing Choice Voucher funds, which are normally used to pay rent, to help pay monthly homeownership expenses. Applicants must be first-time homeowners, have at least one employed family member, and meet minimum income requirements. Programs for Native Americans. FHA guarantees mortgage loans for Native Americans under its Section 248 program. The loans guaranteed under the program are used to construct, acquire, refinance, or rehabilitate single-family housing located on trust land or land located in an Indian or Native Alaskan area. HUD's Section 184 program is insurance for loans made to Native Americans to purchase, build, or rehabilitate property located on or off tribal lands. Section 184 loans can also be used to refinance. These loans are fundamentally the same as regular Section 203B loans, except that they are only available to Native Americans, primarily on Indian land. They also require an agreement with the tribal council in charge of the land where the property is located. Disaster relief. In addition to the 203(h) program, mortgage insurance for homeowners in presidentially designated disaster areas who require major repair or replacement of a damaged home, the FHA has placed a 90-day moratorium on foreclosures for homeowners with an FHA loan who are trying to repair or rebuild after a natural disaster. Loan servicers are required to work with the homeowner on payments, including waiving late charges. Lenders are also required to release homeowner insurance proceeds to the borrower. FHA mortgage insurance premiums. So, FHA mortgage insurance requires borrowers who are obtaining an FHA loan to pay an upfront monthly mortgage insurance premium, MIP, as well as an annual MIP, which is divided into 12 monthly payments. Both are percentages of the loan. The upfront MIP is a percentage of the base loan amount. The annual MIP is also a percentage, but it's based on the amount of the loan-to-value ratio, and the loan duration. Over the years, the FHA has adjusted the percentages for both the upfront and the annual MIP. Let's look at how MIP works with an FHA loan. Example. Your client, Paulo, is buying his first home, a condo, for $100,000. He's making the minimum down payment for a 30-year FHA loan. At the time, the upfront MIP is 1.75%, which he's going to finance, and the annual MIP is 0.85%. Here are the numbers you ran to help Paulo get his brain around the different costs. Purchase price of the condo, $100,000. Minimum down payment allowed by FHA rules, 3.5% $3,500. Base loan amount, $100,000 to $3,500 equals $96,500. Upfront MIP of 1.75% of $96,500 charged at closing, $1,689. Financed upfront MIP amount added to the base loan to get the total loan amount, $96,500 plus $1,689 equals $98,189. Annual MIP amount, 0.85% base loan amount times 0.85% equals $96,500 times 0.85% equals $820.25. Annual MIP amount monthly payment, $820.25 divided by 12 equals $68.35, which will be added to each month's mortgage payment of principal and interest during the first year. Note that the annual MIP calculation uses the base loan amount, not the total loan amount, which includes the financed upfront MIP. The annual MIP is recalculated each year using the end-of-year loan balance, plus the balance after the next 11 payments. The MIP amount will decrease each year as the loan balance is paid down. MIP versus PMI. MIP is different from private mortgage insurance, PMI, in that it's not automatically removed after the homeowner has earned a sufficient amount of equity. For most FHA loans originated since 2013, borrowers pay the annual MIP as long as the loan is active, meaning until the home is sold and the balance is paid off, the loan is paid in full through amortization, or the borrower refinances with a conventional loan. However, the upfront MIP can be partially refunded if the homeowner refinances within 36 months of closing and uses the FHA Streamline Refinance Program. FHA loan programs. The names of these loan programs derive from the legislation that created the FHA. Titles 1 and 2 of the National Housing Act of 1934 delineate the types of loan programs offered by the FHA. Title II programs are named according to the section within the title. Title 1, Property Improvements. This is loan insurance for moderate rehabilitation of properties. Loans on single-family homes may be used for alterations, repairs, and site improvements, includes construction of non-residential buildings, such as garages. Loans on multifamily properties may only be used for alterations or repairs. Loan amounts and terms vary by type of property. Title I, Purchase of Manufactured Housing. This is loan insurance for the purchase of manufactured homes. The loan may be used to purchase a manufactured house on a developed lot, to develop a lot for a manufactured home, or a combination of the two. Loan limits vary by year, and may vary by location for high-value areas. Example limits are $69,678 for the home, $23,226 for the lot, and $92,904 for both. Current limits may be found on HUD's website. Note, if the loan required is higher than these limits, some Title II funds may be available.